Hello and welcome to the Financial Puzzle Playbook with your host, Jim Sumpter. I'm RJ Malik, producer of this podcast. Jim, we've been over the last couple of podcasts talking about the six puzzle pieces of investment. Let's just do a brief recap of the six puzzle pieces, and then we'll get into the main topic of today. How does that sound?
RJ, that sounds great. So if we take a step back and review, there's really six what I call main puzzle pieces of financial planning and any financial plan, and that's cash flow, investments, insurance, retirement planning, taxes, and estate. And so every topic that we discuss is going to fit into one of those big broad pieces. It just so happens that today we're going to talk about investments. And so if we want to call this podcast Investments 101 or Investment Basics, I think that's very appropriate.
Okay. So let's get into it. Let's talk about investments. There are, I'm sure, several layers to it. So I'm just going to get out of your way and let you go.
So I've had a 27-year career, and investments has been, from day one through today. It's a very important piece of anyone's financial plan. It's not the only piece, but it's a very important piece. And we discussed in the last episode cash flow, and we talked about the rule of the 50-30-20, where that 20% is your savings. So what we're going to discuss today is a portion of that 20%. The other thing that we talked about is, having and developing an emergency fund. The investment side is going to be after you have the emergency fund established, or the bulk of your emergency fund established, or if you have a company benefit like a 401k, a 403b, where you're making an investment each pay period, that's where a lot of this is going to fall in. So I encourage you to go back, listen to the previous episode on cash flow. We talk about the 20%. This whole entire episode today is part of that 20%.
Okay. Very good. So let's go to step number one.
So step number one. So I'm gonna, I'm kind of a rule follower. So I have what I call Jim's rules of investments.
Okay.
These are not in stone. These are not ironclad. These are just some rules that I like to follow, and these are at any phase. We also discussed in the previous episode, wealth accumulation, wealth preservation, wealth distribution. All of these rules apply to every single one of those phases at whatever point you are in life. So, what we're trying to do is we're trying to develop habits. And one of the first things that we want to do is anytime we make an investment is we want to have rule number one is, what's the goal for that investment? Is that something, is it a long-term goal? Is it a short-term goal? Is it a medium-term goal? So some good examples would be, if you're 25 years old and you're investing for retirement, you're not going to retire for another, say, 40 years. Well, that's a long-term investment, and that's a long-term investment goal. If if your son or daughter, if you're planning for a wedding that may happen in the next 3 to 5 years, that would be maybe a medium-term investment. Or if you're saving for a child's education, if the child is 15 and they're going to school in 3 years, well, that would become more of a shorter term investment. Whereas if they're 2 years old going to school at 18, then you've got a 16-year window. That's more of a longer term investment. So every time you make an investment, you have to say, okay, what is my goal for this money? What is my time frame for this money? And then step number two is, what is my risk for this money? Now, risk is something that, as an advisor, there is not a right or wrong answer as I'm advising you, and there's not a right or wrong answer as you're trying to determine your risk. But this is going to be more of, what is my expectation for the investment? In other words, do I want to earn market rates of return? Do I want to earn less than market rates? Do I want to earn much greater than market rates? And think about it like this. Let's say an average investment is going to make 8%. and you're going to invest, you want to earn higher than market rates. And that means on average, you're willing to take the risk that you would go up. But if you say, I'm not willing to take that risk on the upside, because guess what? There's also a downside. So I live in Birmingham. Okay. And if you're on I-20 and you're driving to Atlanta, which a lot of people have done, you're going to pass Six Flags over Georgia. And I use this example all the time because when you're on I-20 and you see Atlanta in the horizon and you look over to the right-hand side, you see Six Flags over Georgia. They have this roller coaster called Goliath. What Goliath does in the very beginning is you take off and you're basically doing this, and then you make a little crest and then you drop. So are you willing from an investment standpoint to have your investment go up and down, or are you going to be more like this right here, where you're more like a Batman roller coaster, which goes up and down and up and down and up and down? It doesn't have these big peaks and valleys. And so that's where you have to look at risk. You have to understand, what is my comfort level? RJ, what's going to make you lose sleep at night? Where,
Lo-
where, where, where?
Losing money is going to make me, yeah.
Okay. So losing money over what period of time? And there's, and advisors, in working with your financial advisor, they're going to have some sort of a risk tolerance questionnaire to try to determine what is your risk tolerance. And you're going to get asked, it seems like, the same question, maybe in 4 or 5 different ways, to help determine the risk tolerance, to help see, are you answering this the same way every time? And, so it's really, really important to understand, what is my risk? So that's step number 2. Step number 3, when we invest, is we want to diversify. Now, this is making sure that not all of your eggs are in the same basket. This is making sure that you're diversified among investment types, whether it be a stock or a bond or a real estate investment. This is making sure that, we don't have, all of my money in one particular type of investment. And so let's sort of get into that a little bit. And, I get asked a lot of times, especially when I'm talking with a younger person, they'll say, I'll say, okay, do we want to have stocks and bonds? And they're like, yeah, Jim, what's a stock? I mean, we've all heard of the stock market, but what is a stock really? Okay. So a great example, you walk into Walmart as a publicly traded company. Okay. So you walk into Walmart, and you can't buy stock at Walmart. You buy stock on an exchange, and normally that's the New York Stock Exchange, the Chicago Exchange. There are some other exchanges. There's some exchanges internationally, but it has to be purchased on an exchange. When you're purchasing stock, you're buying equity, you're buying shares of a company. Okay. So you're an investor in that company. It's going to trade on the stock market. And so let's talk about some stock markets that we hear, from time to time. Everybody normally hears of the Dow Jones Industrial Average. What a lot of people don't realize is that's only 30 companies. It's the 30 largest industrial companies in the US. Then there's the S&P 500. We all hear about the S&P 500, another index. What that is the Dow 30 plus 470 more large companies in the United States. Okay. So let's talk about, what is a large company. If a large company is a company with $10 billion in revenue. Now that sounds, a billion, that sounds like a big number. $10 billion in revenue. This is going to be like Walmart. This is going to be like Apple, Amazon. Drive up and down your local road that has all of the shopping facilities, and, a Home Depot and a Lowe's. Those are your big companies. Then there's mid-sized companies. Those are going to be companies 3 billion to 10 billion. So that's maybe some of your mid-sized banks. I was listening to something today, and they were talking about a company, CarMax. And, CarMax is where you can go and purchase a used vehicle. Okay, so CarMax is a mid-sized company. Then there's small companies. These are companies with less than 3 billion in revenue. Again, 3 billion is a big number, but in the investment world, maybe it's not. And these are going to be companies, some more, maybe some of your startups, your biotechs, companies that aren't quite as established as an Apple. But at one point in time, Apple was a small company. And then what happened is it grew into a mid-size, and then it grew into a large size, and now it's a mega size. So when you're investing and you're investing in stocks, you're buying shares of a company. Okay. And so we're buying shares in companies of all different sizes. Then we get into, okay, you might hear the phrase, what's a growth company? Well, what a growth company means is that its earnings, the ability to make money, is growing faster than the average. That's a growth type company. So they're on a very big trajectory to grow, new products, new developments, all sorts of development and growth and research and things like that. Then you've got value companies. This is what I sometimes call like my boring, electric company, because most electric companies are value. So like I pay my power bill to Alabama Power, which is a division of Southern Company. Well, Southern Company is a value company. They pay a nice dividend. They've been around in a good market or a bad market. People are always going to pay their power bill. So you would think theoretically that Southern Company would be a good investment for some people at certain times. Well, that's considered a value type company. So what I've just talked about is stocks. You've got large, medium, and small, and then you've got growth and you've got value. Then you can throw in international, and those are all stocks. So you want to make sure that you're diversified among all of those. Then you look at investment B. Okay, well, now let's talk about bonds, because we've all heard about bonds, and we've all at least heard the name, bond. Well, what is a bond? Well, if a stock is buying equity in the company, a bond is you're buying debt or you're loaning debt to the company. So a bond is a debt to the company. Here's the difference. A bond has a beginning date and an ending date. So if I buy a $10,000 bond on today, or in June of 2024, and it's a 10-year bond, I know it's going to mature in June of 2030. And so in the middle, there's going to be a lot of up and down, but all along the way, it's going to pay me a nice dividend. And that's why I would invest in it, because maybe it's got some more income than, say, a stock would. I'm not really going to get a lot of growth, because I buy it here. I know in 10 years it's going to be here. It's going to be at the same spot, but all along the way, it's paying me some income. So I want to be invested in both stock and bond. Well, then what about real estate? Well, there's ways to buy real estate on an exchange, in a market. There's ways to buy some commodity things like gold and silver. You can't watch a television show today without somebody talking about the value of gold or the value of silver. And those are investments. What you have to do is you have to talk with your advisor, see, are these appropriate? Because that's the other thing. You want to be diversified at an appropriate level, at your risk tolerance, that works for your goal that you have in mind. So those are the first 3 steps. Step number 4, I think it's really important that you understand, what am I investing in? If I'm going to invest $1 or $10 or $100 or $1,000, what am I actually investing in? Am I investing in one company, so an individual stock or an individual bond? Or am I buying a mutual fund, which is a basket? Am I buying an exchange traded fund? There's a lot of these acronyms that I think advisors and the investment world throws around, that sometimes you have to take a step back and say, okay, what is this really? What am I really investing in? So we talked about individual stocks, individual bonds. Let's talk about a stock. So Apple, that's one of, it's a company that a lot of people own, because a lot of people have iPads and iPhones, and they understand what it is. They understand what the business model is. They understand the business, and they say, I want to go buy Apple. Okay. If you want to buy 100 shares of Apple, and Apple is trading at $195 a share, you have to make a $19,500 investment. That means you're investing of your money to buy 100 shares of Apple, $19,500. Let me contrast that to Ford Motor Company. Now, I will tell a story. Ford is the very first stock that I ever owned because my father was a Ford dealer. We've shared that in previous podcasts. I was given some shares of Ford, and today Ford is selling for $12.06 a share. So if I wanted to go buy 100 shares of Ford at $12.06, my investment is $1,206. That is a very different number than 19,500 to buy 100 shares of Apple. So what if I wanted to buy both of them? Or what if I wanted to buy 4 or 5 or 6 or 100 more stocks? How would I do that? What you might do is you might invest in a mutual fund. And so what a mutual fund does is it is a basket of stocks or a basket or of bonds or a blend of all that it may own Apple and Tesla and Microsoft and Ford and Amazon and Walmart and Nvidia, because you want to own all those different companies, but I don't have, the amount of money that it would take me to invest in each of them individually. I can buy them in a basket. And that's what a mutual fund does. It allows you to make one investment. You can, in a lot of cases, put $100 or $500 or $1,000 into a mutual fund. You're going to own a piece of all those companies in a basket of those companies. And so, that's what a fund does. Now, if you invest in your 401k at work or your 403b at work, you're buying mutual funds generally for the most part. And there but you may own 4 or 5 different mutual funds because they have different goals, they have different objectives, they invest in different types of companies, but you're diversifying your investment pool. And that's what we want to make sure that you're talking about. Now, mutual funds, nobody works for free. So the guy or the company or the investment management firm that is managing those mutual funds, they charge a fee for that. That is generally 0.75% to 1.5%, depending on, what you're investing in and the types of companies. And if you've ever owned a mutual fund, you get this big thick book in the mail. It's called a prospectus, which is the rule book. And every mutual fund out there has a rule book, and they have to update those periodically. So you may get a rule book today, and then a year and a half later, you get another rule book, and then a year and a half later, you get another rule book. And what it does is it defines what is the goal, what is the objective, what do I own, who are the managers, what does everything happen in that prospectus. So I encourage people to make sure you understand what it is that you own. The last one that I'll mention is exchange traded funds, because these are becoming more and more popular. These are very similar to mutual funds in that it is a basket of investments, but they trade on the stock exchange like a stock. So it's a way to buy a basket, but you buy it on the exchange, so your exact price that you're buying at. Whereas on a mutual fund, one thing is you buy them at the end of the day. So whatever happens in the market throughout the day doesn't matter in a mutual fund, because it's that end of the day value that you're either buying or you're selling. In an exchange traded fund, you make the purchase or the sale, and you know exactly what you're getting at the moment that you make the purchase or the sale. The last strategy, and number 5 on my rules, on Jim's rules of investing, is a strategy called dollar cost averaging. Now, what this is what we do in our retirement plans. Okay, where every month we put money, call it $100, $500, $1,000, whatever number you're putting into your 401k plan. You're buying shares of your investments every single month or every single pay period. That's dollar cost averaging. So here's the thing. If the market is down and you're putting $100 in, you're buying more shares because the market is down. If the market is up, you're buying fewer shares because the market was up that particular month. But over time, you're averaging into your investment. And so I really like the strategy of dollar cost averaging if it's appropriate, and if it fits into your investment goal, your risk, you are diversifying, so all of these sort of work together. And then and then to wrap it up, you understand what it is that I'm actually owning. And that helps you sometimes to see what your risk is. So that's sort of Jim's 5 rules of investing and investing 101.
Yeah, and I know we talked a little bit before. You wanted to get the 5 rules out there, but you said you had 2 bonus rules that you wanted to share. So I think we got time for that. So why don't you share those rules?
All right, so I have 2 bonus rules. Okay. Let's talk about the power of compounding. Okay, now I'm going to give some examples here. And RJ, I'm going to ask you a question.
Okay.
If I said, I'm not doing this, but if I said I was, if I give you would you rather have $1 million today, or I'm going to give you a penny today, I'm going to double it tomorrow, and I'm going to double it again, and I'm going to double it every day for the next 30 days, what would you take?
Only a penny, but I do
Today you
know
get a penny.
right.
Tomorrow you get 2 pennies. The next day you get 4 pennies. For the first, few weeks, you're
Well,
looking like a moron.
for first, I'd say, can't we go maybe 6 months instead of 30 days? No, I'm
No.
kidding.
No.
Yeah, I'm going to say I want the compounding.
You want the
Eh,
compounding. Okay.
yeah,
Let me give you the math. Okay.
sure.
The math is, if you took a single penny today and you doubled it every day for 30 days, at the end of 30 days, you would have 5,368,709.12.
Mm,
So you would be much better off
right.
with option B, taking the
Yeah.
penny a day.
Yeah.
Now I'm gonna talk about the power of compounding just a minute, and talk about the power of doubling.
Mm-hmm.
Because if I said, RJ, I'm going to do that for 27 days, not 30, but only 27,
Huh.
what do you think happens?
You lose a lot.
You lose a lot. Okay, here's what you would have at the end of 27 days.
Okay.
$671,088.64.
You get, I mean, compared to the 5 million, you get crushed.
So those last 3 doubles really make a
Right.
difference.
Right.
Okay. It
Okay.
makes a tremendous difference. We've talked about the power of compounding, the power of doubling. We've talked about consistent investing, understanding what it is that you own, diversifying, and making sure that your risk tolerance is such that you get your appropriate rate of return. All right.
Oh,
That was the other thing that I wanted to mention. The last one that I want to mention is a very it's a basic rule. It's kind of an interesting rule, and it's math, and it's called the rule of 72. And we talked about doubling. So remember, going back to my penny example, and I said the importance of those last couple of doubles. Okay. Rule of 72 says this: how long does it take money to double? And the answer is, if you take 72, the number 72, divided by an interest rate, that's how long it takes money to double. And that's really kind of what I wanted to demonstrate in this episode, is the basics of investments. We're going to get a lot deeper into a lot of these topics as we move on, but this is simply the basics.
well, I think you covered a lot, and there's a lot of information there that, I've been around for a little bit. You can see all the gray in my beard. And I learned a lot today, which is, that phrase, you can't teach an old dog new tricks. Well, I was taught a trick or two today. Thank you.
Well, like I said, I've always taught myself this along the way too. I wish I had, done some things sooner in my
Yeah.
personal life, but
Yeah.
there's tremendous opportunities out there for everyone. The biggest thing as an investment advisor that I would say is I want you to make sure that your investments are appropriate for your specific situation. Everyone is different. There is nothing that is cookie cutter. It is all very specific to your goals, your objectives, your time frame, your risk tolerance, and it's important to understand what all those are.
Excellent. Jim, how can people contact you?
Yeah, so there's a few different ways. Our website is www.cmcfp.com, so cmcfinancialpuzzle.com. My direct phone number is 205-510-9074. Email is jsumpter@cmcfp.com. And then we have all the various socials, and you can contact us that way as well.
Jim, as always, it was a pleasure talking with you, and it was very informative. Thank you so much. And most importantly, thank you for listening to the Financial Puzzle Playbook podcast. We ask you to share this podcast, rate it, and leave a review, because this actually helps others find the show. Again, thank you for listening. And for everyone at Financial Puzzle Playbook, I'm RJ Malik, and we'll see you at the next podcast.
Thank you for listening to the Financial Puzzle Playbook. Click the follow button to be notified when new episodes become available. Don't forget to follow us on social media by checking the links in the description. And contact us today by visiting our website at www.cmcfp.com or give us a call at 205-510-9074. Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security, or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analyses of CMC Financial. It does not necessarily represent those of RFG Advisory, Private Client Services, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by CMC Financial or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Securities offered by registered representatives of Private Client Services, member FINRA SIPC. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Private Client Services, CMC Financial, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.